Welcome everybody to Healthcare Markets International webinar on opportunities in the European healthcare real estate market in partnership with Bevan Brittan. I'm Nick Herbert and I'm the editor of Healthcare Markets International, and I'll be moderating the event today. European healthcare real estate has performed really well in recent years and through COVID, providing investors with solid returns even as other parts of the real estate sector suffered. Its long-term potential is also underpinned by the demographics, of which we're all aware. Already more than 1/5 of the EU population is 65 and over, and by the end of the century, the proportion of citizens of 80 years and over will rise from 6% to 15%. With an ageing population comes increased demand for services and quality healthcare, and underpinning that is demand for real estate. Now, it also has the advantage of inflation-linked annual rental increases, which is very pertinent at the moment. But does its history of resilience, underlying demand and support and inflation protection still hold true in the volatile markets in the world in which we live? So we've gathered a panel of experts together today to consider the opportunities and challenges facing European healthcare real estate. Rising inflation, rising interest rates, and the impact of ESG considerations into new builds and renovations. We'll also look at seeking opportunities by geography and segment. We'll look at the state of the competition, and we'll also take a keen look at the UK market, where it has been a momentous few days in terms of foreign exchange and interest rates. Now, the webinar lasts for about an hour. This is a hard close at 11:15, and there will be time for questions. We've already been receiving some, but keep them coming in. If you miss anything or want to catch up on the discussion at a future date, then there will be a recording available on the LaingBuisson website this afternoon, and you'll be sent a link for the on-demand webinar. Okay, let's get the panel to introduce themselves. I'll call on Charles-Antoine first.
Yes, good morning. So yeah, very brief introduction. I'm Charles-Antoine Van Aelst. I'm the Chief Investment Officer of Aedifica. Few words about Aedifica for the ones who don't know us yet. So we are a Belgian-based specialized healthcare REIT, listed on the Brussels Stock Exchange and the Amsterdam Stock Exchange. We invest specifically in healthcare real estate throughout Europe and are active today in 8 European countries, mainly in the northern part of Europe and also in Spain. We have a portfolio of a bit more than 5 billion euros under operations today, in partnership with, I think, more than 130 operating tenants, so operators. And on top of that, we also have a development pipeline, ongoing developments of about 800 million that will be added to our portfolio in the coming 2 to 3 years, let's say. The main focus of our investment strategy today fits within the nursing home, senior housing part of the healthcare real estate markets, but we also have some more niche products like children daycare in the Nordics or specialist care in some countries, depending where there is a market or not. I think that's in short about Aedifica and myself.
Lovely, thank you, Charles-Antoine. Can we move to Frederic? Would you like to introduce yourself?
Yes, hello Nick, hello everyone. I'm the Group Chief Real Estate and Development Officer from Korian. Korian is an operator who is responsible for healthcare provider in 7 different countries. We are operating around 1,000 facilities in 7 European countries. Most of these facilities are rented out to investors, but 25% of these facilities are also owned by Korian. And this facilities represent a gross asset value of 3.2 billion euros at the end of 2021. That's it.
Thank you very much, Frederic. Sarah, could you introduce yourself, please?
Good morning, everyone. I'm Sarah Skuse. I'm a healthcare real estate lawyer and partner at Bevan Brittan. I act for operators, providers, developers, funders and investors, helping them to buy, build, lease, loan, develop and dispose of a wide range of healthcare real estate assets.
Thank you very much, Sarah. And Julian?
Morning all. Julian Evans. I head healthcare for Knight Frank. Globally, we annually advise on around 40 billion of healthcare assets, and that also captures senior living, and it's across the piece in terms of different situation classes, say primary, secondary, social care, and acute care. That's it, Nick.
Lovely, lovely, very well summarised. Thank you very much, Julian. Let's get going then. Can everyone return to the videos and mute buttons off? Very good. Okay, Charles Antoine, I thought I'd give you the nice, easy question. Is he still there? Here he is. I thought we'd start off with a nice, easy question for you, considering your activity and your pipeline. Is European healthcare real estate still a good sector in which to invest?
Well, yes, of course.
I knew it would be a one-word answer.
Certainly, if you're having a long-term perspective, as we have, and as you mentioned in your introduction, I think the main fundamentals of the sector are still very, very positive. Of course, the demographic evolution, the big shortage in appropriate infrastructure for healthcare, all kinds of healthcare, I would say, in future, and probably the situation in which the market is today will even increase the need for the future, because as you start to see, not only in our sector but in general, some projects or development projects being put on hold, you can imagine that this will create an even larger shortage of quality real estate in the future. So I think in the medium to short term, we can all say it's still very positive. Today, the market, for financial reasons, is quite tricky, but I think the healthcare real estate sector has very good fundamentals.
It's good fundamentals, but we're living in a world with rising inflation. How does that affect your strategy?
Well, we have to take that into account for sure. I think we both in our discussions with operators, of course, because as you also mentioned, we tend to have inflation-linked lease agreements, sometimes with fully indexed, let's say, and sometimes with caps and collars or time lags, etc., depending on the country in which we are active. But one of the very important aspects also for investors in companies like Edifica, who like to indirectly invest in healthcare real estate, is this indexation possibility. But a big part of our underwriting is also to make sure that we leave enough headroom with the operator to be able over time to tackle potential issues that might arise. But of course, if you're sitting on existing assets and you have very high inflation and indexations, you need to sit with the operator and see, well, make sure you don't end up killing the operators by applying rents which are far too high. So it's a constant discussion with our partners, evaluation of the situation, and there's no one issue or one solution for all of that.
I think that's a good opportunity to move to the operator, Frederic. You're at the other end. It's an inflation link is great for the investor, not so great for yourself when you're experiencing such a high increase in input costs.
Yes, and I saw the chat and I saw already a question for the operators, and the question reads, how can operators survive in an environment where costs are rising everywhere? So that's partly, and in order to answer this question as well, it's the capacity, in fact, of the company to build back the inflation to its clients or its residents. So fundamentally, in all business, if you have rising costs, you should at a certain moment raise your price, and that's where inflation comes in. Of course, the capacity of operators is linked to the capacity of operators to bill a portion, at least, of the inflation. After that, of course, with rising wage, with rising energy costs, and with rising interest rates, it's more difficult. Let's say margins are under pressure. So in the short term, of course, your margins decrease. That's automatic, because the indexation of rents for residents are not, well, it depends on the countries, but usually, for example, in France, you have to wait for the beginning of the year to index, to be able to build back this inflation to your residents. So in the UK, it's possible to index more times and more frequently in the year, but for example, in France, it's more constrained. Then, of course, it's a difficulty for our business. It's a difficulty for other business as well. What is interesting, I think, is the resilience of healthcare real estate assets, because when we look at it, COVID has severely hit the economy, no doubt about it, and even the war and the energy prices are conducive to more costs for the operators. But yet, regarding the healthcare real estate, and we can also see it from the real estate we own, the valuation of Cushman and Wakefield or Jones Lang or other operators are really based on the transactions. And when you look at the transactions, the prices of healthcare real estate has not decreased. So that's what I believe is that there will be a fall in transactions before there is a fall in prices. But yet, I don't see the fall in prices. I can even say that for real estates, for example, in Germany, it has also in June, at the end of June, because with vehicles, with pan-European vehicles that we own, we can see the valuation improving in the German assets. So we'll see, but probably it's we are probably coming at a limit. Maybe Julian will elaborate on this.
Thank you very much. I noticed that Charles-Antoine was talking about caps and collars on these lease agreements. Are you having those discussions at the moment, Frédéric?
Yes. Regarding owners, it represents 75% of our portfolio is leased, and so we address with our most larger investors the possibility to freeze indexation, for example, for 3 years. That's and we have been, let's say, quite successful in doing it this year with some of our partners. And of course, if you ask me, what do you give in counterpart? It's usually some leases that will come to an end, and so you rediscuss, you renegotiate your package of leases, and you can say, look, I'm ready to take more years. So for you, it's beneficial as an investor because the direct valuation of your asset depends on the length of the lease that we will conclude together. But please allow for indexation freeze for 3 years due to the fact that the situation is at the moment difficult. And the discussions that we launched are, let's say, meet our the standards or the objectives that we had before. So that we have to try, of course, to make some win-win discussions in this. And of course, it triggers discussions when you have some pressures on inflation.
Getting a nicer, closer relationship. That's always nice. And I noticed, Sarah, that Frederic was saying there's no evidence of price decreases in valuations as yet. Is that and certainly in Germany? Is that reflected in the UK? What's happening in the UK?
I think that's probably one for Julian on values, but just to the point about sort of rent and indexation and capped, because that's come up a couple of times. I think in the UK market, you know, one of the attractions is the sort of the long dated leases, 35 years, triple net leases, and operators will undoubtedly want caps on their rent increases, and that is very common in the UK market, balanced with probably. And that's very common that we see. I don't think I've dealt with many leases at all that haven't been capped in that way. There's usually a collar as well. I think also there's financial covenants and holidays for those will in the short term need to be looked at, most probably with rising costs and development fill-up rates. So I certainly think there is an impact in terms of valuation as a whole on the leases if you value them at a point in time. I think probably it's one for Julian though around the pricing more generally.
And just in terms of how are these inflation and high interest rates affecting your clients and their decisions?
Well, you know, obviously there's quite a significant cost pressure on the operators and providers anyway. There has been around rising energy costs, staffing costs, the cost of fuel are and have been for a long time pressures on operators. So they are looking, you know, the margins are tighter. The cost of debt is increasing and the availability of debt in the market and the sort of criteria for that is also tightening. So people are looking at different ways to raise debt. Sale and leaseback model is quite popular now. We're doing a lot of sale and leaseback work where traditionally people have looked to debt funding really for what they're trying to do on an acquisition or growth portfolio play. So we're seeing a lot more of that, and I think that will probably increase, although you know, there's not that many people who are doing, for example, debt finance in the high street market, but there are other funders looking at bringing new products in. So I think some of the pressures will cause innovation in terms of how people will fund in the UK, certainly.
Very good, and thank you very much, Sarah. And Julian, you've got the answers to those valuation questions, I believe.
Yeah, but this has been recorded, Nick, so couldn't possibly fess up. So I think cap rates are holding firm at the moment, but you know, if you look at the REITs or many of the REIT share prices at the minute and the wider property markets, I think it would be naive to think that cap rates are necessarily going to hold out at levels that we've experienced certainly pre-COVID. I do think certain elements of the sector have been overpriced. And so I think we'll see a normalization. So in other words, I think when we're looking at what you would call annuity grade or 5A1 covenant type yield, you know, they've been incredibly tight at around 3.2% net initial. And I think we'll start to see an outward yield shift on that. I think in the real world of social care and the healthcare arena generally, if broadly we're talking about a cap rate of around 5%, is that likely to hold firm, subject to all of the considerations? I think it will, and I think to a lesser or greater extent it's being underpinned by the elements that you opening gambit with, supply and demand, but also supply chains. the thing about healthcare, whatever the asset class, generally speaking, they tend to be bespoke real estate buildings. So that I think is an element of what makes it a very defensive and insulated sector. So I think core mid-market will hold firm. Again, it could be a portfolio. Is there a portfolio reverse premium there now because of the lot size at say 300 million, 350 million plus? Yes. So it's on a case-by-case scenario, I think, Nick.
And just in terms of those transactions going through, are the valuations from sellers and investors, are they still close, or are they moving further apart?
Depends what it is. If it's holdco, so if it's a going concern and it's a multiple of EBITDA, that's probably holding relatively firm at the moment. If it's real estate, or what we call fixed income, in other words, a leased asset, which is pertinent to Charles and Frederic, then they're holding firm at the moment.
And what about the financing of these investments? How's the bank market approaching the current situation?
It's difficult. It's definitely getting harder, without a doubt. Sarah alluded to the fact that the high street clearing banks, so from a real estate perspective, that's getting tougher. So LTV ratios are probably pared back from say 65-70% pre-COVID, could be down to as low as 50% now. So in other words, your equity check has to be higher. The repricing of debt, SONIA, swap rates is impacting the market, and so you're not getting the favourable debt terms that we saw pre-COVID. So it's more expensive. But of course, the vendors are still holding out for a price of say 9-10 times multiple, or if it's a fixed income proposition, actually, do you really want to sell it if the market looks like it's cooling off because it's all about income?
Mm-hmm. Okay, and Charles-Antoine, in terms of financing your investments, I mean, you use the equity markets, you use the bond markets, and use the bank markets. How are you finding the situation?
Yeah, I was going to react to what Julian just mentioned. Also, add to that there's probably going to be more and more a flight to quality of the buildings, and also, well, ESG. Given the energy crisis in which we are, we've seen that evolution already coming through the last 3 years, with increasing demands from investors and from funders, from banks, in terms of ESG criteria. But at the same time, we saw so much capital wanting to enter the market that we saw that the yields didn't really diversify across building quality. And I think probably that's also where in current markets there will be a difference again in yields between very high quality buildings and lesser quality buildings.
Does that suggest that new builds are better from an ESG perspective rather than refits?
Depends of the structure of the existing building that you want to refit. We in our portfolio we have older buildings that we managed to completely refit, and they're as good as new, let's say. And you also sometimes see existing buildings which, you really have to tear down because the structure in terms of hallways and rooms, etc., or height of ceilings, etc., are just not allowing for a proper redevelopment. So it's really a building by building case.
Fair enough. And Frederic, you've also been in the bond markets with sustainability deals and social deals. How is ESG affecting your operations?
We have decided in 2018 already in Corian to make a bilan carbon. So it's a balance sheet assessment of how much carbon, how much CO2 emissions are you emitting per year. And we have since always included capex, what we call energetic capex or energy capex, in order to minimize the long-term effects of the CO2 emissions. So we took a commitment in 2019 is to decrease on our buildings by 40% in 2030 compared to 2018, the emissions of CO2 of our buildings. So we are now in 2022. So we have we make every year some energy capex, and we have also invited our investors to do the same. So in fact, what we have done is, and I see, and it will be also an answer to the question that I received in the chat. Like Orpea, are you putting some of your properties on the market? The answer is we are not like Orpea, meaning that in fact since 2019, Korian is building some real estate companies in which he puts real estate assets, and we finance together with investors these real estate assets. So the first vehicle we did in 2019 was about an investment program of 300 million, which is now over. But we put on the market in 2020 1.1 billion euro real estate assets, and that was subscribed by BNP Paribas Cardiff and EDF Invest. And last year, in 2021, we also put a real estate vehicle on the market for 400 million, and it was subscribed by British Aerospace pension fund. So unlike Orpea, let's say, but we have decided for real estate to share our real estate, not only for 100% for ourselves, but with external institutional investors who share with us a long-term vision. So that makes us very different in that respect. Maybe the question means, do you put properties in sell and lease back? Let's say, like most operators do. And here I say yes, we do around 5 per year. So we have 1,000 facilities, and we will sell and lease back typically 5, maybe 2 less, maybe 2 more, but around 5 per year. And the reason is we are owner of some real estate assets which are very costly tax-wise to move from one portfolio to the other portfolio. And therefore, when it's too costly, we prefer to sell these real estates completely and have 100% of the proceeds of this sale, rather than having 49%, because when we are with investors, we keep 51% share of the title of the real estate company, and we let investors being at 49%. So meaning for the example I gave in 2020 with BNP Paribas Cardiff and EDF Invest, each one has 24.5% of this vehicle, meaning
okay, I noticed you mentioned going into partnerships with perhaps non-specialist real estate, healthcare real estate investors. Are we seeing more in the rise of that kind of private equity investment and the big infrastructure funds putting more money into healthcare real estate? Julian, are you seeing that?
We are, but we've been seeing that for 18 months, maybe. I suppose, if I'm honest, what I have been surprised around is private equity. So the typical gestation period for new build care settings. So say you had, let's say Korian, Frederick's got a new development site in Paris. It's 100 beds, state-of-the-art facility, best will in the world, from planning to turnkey, delivery of the building, commissioning. In the rounds, it's going to be around 18 months. And then to get to full capacity, maturity, I think I'm probably in line with France on this. It's another three years, probably 4, if you're targeting the self-pay market, or certainly in the UK. That's a 5-year horizon. So actually in the past, it hasn't really worked for private equity when they're trying to get to their mid-teens IRRs on a five-year horizon. That's changed. And I think the significant capital that they're sat on, they've got to deploy it. So I have been pleasantly surprised with that. And also when you think about that change in LTV debt provision that's now been pared back, they're having to put more cash in, their own cash into deals. But we've got a number of portfolios that are under offer now between 50 and 100 million, which are pure cash, pure equity. Now they will debt up post a transaction, I hope. So that's been quite a pleasant surprise. Infrastructure funds such as AMP and Equitix and other global players have been relatively prevalent because they've been looking to substitute the traditional infra plays such as road tolls, motorways, etc. Airports, for example, which we all know have been impacted by the pandemic. So I think we've definitely got a very broad church of different investors at the moment, which is comforting, because ultimately the problem that we've got with healthcare, or when you're a specialist, you get too siloed and blinkered, or you can do, or I do. And you've got to remember that, you know, the broader markets, it could be the bond markets and it could be the other property markets, and what the WALTs are within a respective jurisdiction or country. So in the UK, the average unexpired commercial lease is around 2 years. Then we're talking about ESG. That's having, you know, that was window dressing pre-COVID, no longer is. That's having a big impact. Green loans into the market. Then you've got the institutions that don't tend to be geared, so they can be a bit more competitive. Then there's the reweighting of long index funds away from retail, possibly leisure and hospitality, which is a positive. So at the moment, we're in a bit of a perfect storm. I think actually it's a critical point around leases and the indexation around that. And it's really heartening to hear Frederick's response and Charles in terms of what I think is much more about a partnership with the landlord and tenant. It benefits nobody, none of us on this call, to watch an operator suffocate. So I think there's much more maturity around managing the aftermath of the pandemic. And you know, the thing, when I speak to most investors globally, actually, I hate to say it, it comes down to what Putin's actions are going to be. That's the big conundrum that's sat in the background. So I think we're managing this literally on a week by week, possibly month by month basis.
Thank you. And Charles Antoine, are you seeing more in a different breed of investor in the market, or are they starting to retreat in these volatile conditions?
I think, well, today we can only talk about the past. I think post-COVID, there's been an increasing number of new investors, so an increasing number of competitors, additional competitors coming into the markets. As Julian said, diversifying away from other sectors, coming into healthcare, etc. So this has probably also been driving prices, as we said before. Sometimes, in some cases, without too much focus on quality. So that's probably why that focus will come back. But I think it's still very early to say if that will change, if those investors will go away from the market again. I think there's a lot of questions being asked, as we mentioned before, about operator profitability, etc. But I think that they're still too early to say if that will really change. I think, to give an example, some years ago, probably to work on a European healthcare real estate portfolio, there were 5 to 10 candidates, probably even closer to 5. Before COVID, there were probably 20 candidates, and I recently heard from someone who wants to sell a portfolio in Germany that they had a list easily of 50 candidates. So there you see that the attraction of the market has been really increasing over the years.
And what's been happening to yields under that kind of pressure? I can guess, but carry on.
Well, the yields have been compressing, of course, but also due to the very, very favorite level of interest rates, etc. And also, of course, the market became more professional. The healthcare real estate market was actually almost inexisting, let's say 10 to 15 years ago. Now it is a market, it is a sector. We have webinars around this and conferences, and you have it as a real estate sector, which wasn't the case. So I don't think the market will go back 15 years to a level where there is where it's still very, very extremely fragmented as it was. So it was a normal thing to have yield compression in that environment as well.
Very good. And Julian, you want to come in? Yep.
Well, yeah, Charles hit the nail on the head for me. I think it's metronomically different to where we were 15, 20 years ago. The investors are so far better educated around the different types of registrations and the buildings and the care settings that they're investing in, and that also would capture the leases as well in terms of the different financial covenants in there. It's a proper working relationship in that regard. So if you invest into the sector, you understand the reputational risk, and that ultimately is one of the biggest red flags for those that don't understand the sector. So I think the gearing and the structure of the majority of the leases now, and to Charles's point, is so much more professional than it was 15, 20 years ago. If we have the situation of another Southern Cross in the UK, which collapsed in 2010, I would be highly surprised. I think the gearing now is far more sensible. There's decent headroom in terms of rent cover for the majority of the portfolios.
Are we seeing any sort of like retraction in yields yet? Are they coming off, or are we just going to carry on at these levels?
I think the whole firm. Because of the strength and depth of different investors coming into the market that do need to reweight their funds. If you're talking about fixed income, but Spain, in our opinion, when we're valuing Sanitas and Euresidential, has got better real estate than there is in the UK. Probably Germany has got better real estate. So I think the different jurisdictions have got different offerings and different structures and different dynamics, and that's around regulatory concerns. But also, if you're looking at where 10-year gilts are, broadly 4%, that's going to potentially dissuade certain institutional capital into the market. So it's difficult to call at the moment because things are changing, but it's still a supply and demand issue. So I think in most cases, yield and cap rates will hold firm.
Okay. And you mentioned in Spain and Germany. Where do you see the opportunities, Charles-Antoine, for you've been a big investor in the UK this year. Indeed, on Monday you announced 2 more additions to your portfolio. Where do you see the best opportunities on a geographic basis, and why?
I think we still see a lot of opportunities a bit everywhere because, as I mentioned before, we are a long-term investor, and so we look at those long-term fundamentals. And I think more or less everywhere in Europe there is a big necessity for quality assets with quality operators, etc. Of course, you have differences across Europe in terms of lease agreements and other specificities. But over the last couple of years, also yields have been going or evolving towards more or less the same kind of levels everywhere. And probably that is not so logical if you compare, I don't know, three years ago, or it was 3 years ago when we decided to go to Finland. Everybody expected us in Spain, but for instance, we saw yields in Spain at 5%, but we could go to Finland at 6%. So that's why we decided to go to Finland, even though we know that there is also a big potential in Spain. So we're also looking at where we see at a certain moment in time the best potential to invest the equity or the capital that we have. But I think all over Europe, if you look medium term, short, long term, still a very good market to invest.
Fair enough. And Frederick, do you see that yields reflect the risks in different countries? Are you being rewarded for the different risks in different countries?
I believe that it's difficult to answer this question because I have specifically 2 hats, one as operator, one as a real estate investor. And what I see regarding the yield of healthcare real estate assets is that, of course, you have a part of the yield which is really linked to the real estate asset. So, for example, if I tell you that we are at 3.5% yield in Paris, you will not be surprised. But as Charles-Antoine said, you have also, and due to the yield compression, I must say, I'm quite surprised also to see some 5% yield, for example, in Spain. because just 1 or 2 years ago, it was more 7% than 5%. So I believe that at a certain time, we had a spread between, for example, Paris and Spain, which was 3-4%, which is now maybe 150 basis points only. And if you tell me, I don't feel that it reflects exactly the risk. I would say I'm more at ease at 3.5 in Paris than at 5% in Spain, personally. So this is why I think we should really see each market, each opportunity, and also each asset class within the healthcare real estate, because within the healthcare real estate, of course, you have some acute care, some post-acute care, you have some nursing home, and then you have some assisted living. And of course, these yields are also higher in acute, and then next to higher in the post-acute, and then lower in the nursing home, and then even lower in the assisted living. So the more, in fact, you travel to the residential sector, and the less risk premium you have. And this I can understand, and it's fine. But depending on the market, you don't see exactly the same spread also on these different asset classes. So this is why I think we should be very, let's say, careful in assessing what is a good yield. And I also saw the questions for Korian, what kind of yields are Korian expecting on their properties if they were to sell them? You know, we are expecting at least the market yield. And when I would say when we sell, when we make sell and lease back with many investors, usually the price we get is higher than the valuation we had ourselves. And that's, I would say that's, well, for 5 buildings per year that we sell in sell and lease back, I can tell you it's exactly that. Regarding when we put our real estate assets in vehicles, then what we will have is the valuation that we have, because of course on a 1 billion euro transaction of assets, you should get what the valuation company tells you, and that's what we have also. So we are not surprised, but what we can have as yields when we sell, and when we buy, we are also looking at it, and we prefer sometimes to rent rather than buy if we feel that the price is not worth it. So we are, it's really our asset smart strategy. We are really assessing each time, should we own, should we rent? That's always the case.
Thank you very much. And Sarah, are you seeing any differentiation in the attraction or attractiveness of different sectors in healthcare? We've been talking mainly about long-term care. Are you seeing any other sectors in the asset class that are finding attraction?
I think healthcare real estate generally is more attractive currently and has been for a long time than other real estate classes, such as retail, for example. You know, aside from sort of warehouses like Amazon, etc., there's just generally sort of most investors are trying to increase their exposure to healthcare real estate, and then within that, adult social care. Adult residential care has been very popular. Specialist care continues to be popular because of the underlying revenue that sits beneath it. And we've got a number of rehab deals on the go at the moment where people are looking at rehab facilities and in some cases converting existing elderly residential care units because of the higher weekly income from rehab. Children's services and mental health, particularly post-pandemic, there has been quite a spotlight in terms of the undersupply on that, which again is driving interest. I think just sort of in terms of the opportunities in the UK, I suppose one of the things that we're seeing is from investors looking for development funding opportunities is just the availability and the price of land. And that's driving competition, and those with deeper pockets who can bid for things on an unconditional basis or move quickly and not reliant on gearing tend to be in a stronger position to win those types of opportunities. And that's all got to line up with the case for a new development when we know that sort of 70% of the existing care home stock in the market is over 20 years old. So that in terms of the actual deals on the ground, they're changing in terms of the structure of them. They are, it's a seller's market in terms of being able to command unconditional rather than con deals. And then you've got the planning issues that go with it, to the point that Julian made about sort of the pipeline and the incubation period before you get a facility that's up and running and fully occupied. So we're seeing quite a lot of that. Yeah, so I think rehab is an area that will grow, and lots of interest in that. But traditionally, specialist care has, I think, for the last couple of years anyway, been attractive to investors, and I can't see any change in that given how the funding works and underlies it all.
Okay, and do you see the sort of same kind of spread compression between within countries, between sort of like regions and city centres, and that Frederick was explaining between Spain and Paris, for instance?
Well, I concentrate on the UK market, but I think Charles Anton's deal that went through yesterday, the 45 million, that's a perfect example. I think it's Norfolk. It's all out of Greater London, the 3 sites that you've invested in. So it's not London centric, and many, which is good because the land prices there are obviously an issue. So it's all across the UK that we're seeing investment going in. The rise of senior living, integrated retirement communities is also sort of changing the landscape in terms of what people are looking at in terms of acquiring sites and looking at exit plans, what they could do with the sites if they couldn't get planning for it, and looking at other possible schemes, and increasingly seeing people move to consider close care homes or a retirement village or something along the spectrum that adds to the existing portfolio. And I know that if you could do a lot around senior living more broadly than adult sort of residential care.
Fair enough. And Julian, do you see this as a good opportunity in the market for consolidation on a grand scale? Is bigger going to be better in this environment?
Depends on what optic. I think if you're going to market with a sizable portfolio, well, let's go extreme as far as the UK is concerned. Barchester Healthcare, circa 4 billion. It's an oil tanker, so that it is almost impossible to sell. Although the senior management team would probably shoot me for selling that. But there's other opportunities around that portfolio. So I don't think necessarily bigger is better, because trying to get the debt and the equity at that quantum is really difficult. But I think it will be, against Charles's point around flight to quality. And then it's drilling into the nuances again. So in the UK, we've seen a drop-off of almost 50% of bed capacity in the UK within the private sector. So acute and mental health hospitals has dropped from 300,000 beds to whatever it is, about 145,000 beds. So we've got a national bed crisis over here. But actually, if you look at when we ran into the pandemic in terms of ICU beds in the UK's per capita, I think we're around 9 ICU per 100,000. Italy's better, it's around 15, 16. I think Germany's at 34 IC intensive care unit beds per 100,000 capita. So I think it depends what it is, and I think it depends on the shape of the capital. But I think ultimately, we've been through these cycles before. This is slightly different, and there are different headwinds. But I think ultimately it will be around flight to quality.
Very good, very good. And just one more to Charles Antoine. What's the biggest challenge for an investor at the moment? Everything looks pretty good according to the panel. So, well, what are the challenges?
At this very moment in time, it's volatility on financial markets. It's very difficult to say where things are going to go. It changes from day to day or from week to week. So a bit like Julian said, if you want to work on a very large portfolio today, where you need to find equity and debt, it's difficult to say financially how you can price that in today, because it's very hard to say at which conditions you will be able to raise that debt or equity a few weeks from now. So that's really the market volatility at the moment. Probably the hardest thing to manage.
Just go back to that bigger or better and the portfolio size. So you've got Corian and Edifica here. I think they are certainly market leaders in starting to track what we've believed as a house for some time, is that ultimately social care will probably follow the line of the hotel arena and going cross-border. It will be global branding, and you're seeing that with Corian and Edifica. So it's coming. The sector's 20-25 years behind the hotel arena in terms of senior management team, branding, professionalism, and a lot of other things. But I wouldn't want anybody to, but in my opinion anyway, to drop off this call thinking, you know, the sector's cruising along. There aren't any. There are. You know, there's a hell of a lot of issues around staffing. A lot of red flags around that. There's a paucity and a deficit of skilled nursing. We've got the energy costs and bills which have gone up by. So for hospitals, they've gone up by 4 times. For typical care settings, they've gone up twice. So if you've got a 60, 70 bed care setting, which the energy bills would be around, say, 35, 40,000 a year, that's doubled and some. And then it depends on the age of the asset and its efficiencies. So there are a lot of operational issues that the social care providers are having to manage at the moment. So it's not easy. It's not easy.
And Frederick, do you base your business model on the full seasons? Is that where you're going?
It's as we say, the times are difficult regarding when we look rising inflation, rising energy costs, rising interest rates. Can we still invest, for the future and for the future of healthcare real estate? Let's say that we were very happy in July because we were able. I talked to you earlier about the 300 million euro that we have developed for the first portfolio, and that was to expand our networks of co-living in France, in the rural areas, so next to the big cities. We are not in the big cities, we are really in the small towns. And we were able, with the same actors, same investors that we had in 2019, to sign with them again a 400 million euro investment program in these co-living activities. So we think that, and because of the uncertainty, because of the fact that healthcare will cost more, because we know when we have inflation, energy costs rising, interest rates rising, of course healthcare will cost more because the demand for healthcare is quite inelastic. So the people will continue, but it will absorb more of their revenues. At least these kinds of solutions we see are solutions for the future, because typically they are less expensive than traditional nursing homes. So for example, in France, they cost about 1,700 euro net for the resident. When you compare it to a traditional nursing home, public nursing home, it's 2,000 euro per month. And a private nursing home, and we are a private operator, it's 3,000 euro per month. So you see, we have to develop alternatives, so to be in different areas, not only in the largest towns, but also to be in places where costs of construction are also very low, and typically this co-living activity that we develop, we buy the land at very cheap price, and it's less than 50,000 euro per for the whole piece of land. And of course, we try as much as possible to standardize. The product is fully standardized, and to automatize and industrialize, let's say, the construction of it, in order for us to still be low, also in terms of construction. So that's of course, as you know, a challenge in the current environment. But I believe that to develop smart housing, let's say housing which is cheaper than average and aimed for people in rural areas who are on average, the population is aged more in rural areas than in urban areas. So we thought this part of the market was not addressed, and we address it through this second vehicle that we just signed 2 months ago. So that's nice, and of course we hope that we will be able to have some more equity funding in the sector, but we are confident that we have done in France, we'll do it now, this kind of co-living activity, and we also aim in let's say in a few years to do it also in the UK.
Very good, very good. And just that we got time for a few questions, and perhaps what you said, Frederic, about keeping costs low in the build, is this a good one? And can you tell us by how much energy costs have risen since 2020, and what percentage of revenues they represented for operators in 2020 compared to now? You any thoughts on that one?
I believe that energy costs this year for Korian represent around 85 million euros. 85 million euros. This has to be compared with a turnover which will be over 4 billion euros. So it's I would say, I believe it's not the double, but not far from being much more, well, between 50% or more than what we paid before. Despite the savings that we are doing, because we are doing, of course, many savings. As I said it, and it was also a question in the chat, how much we think we have saved in energy cost. I would say around 10%. So if we would have not made these investments, it's not 85, but more 95 million that we would pay this year for energy. And I saw another question regarding hedging. Is it time for hedging? You know, when you don't know how the price of a commodity will evolve, for example, the gas has at its peak in July, August, and now is down compared to its peak by 40%. So you have to buy one part, let's say 10% or so of your to cover yourself each month if you don't know exactly what the direction will be. And nobody today is able to say, okay, the direction will be absolutely downward for 3 or 4 months, for 3 or 4 consecutive months, or upward for the 3 or 4 consecutive. We have no idea. There are some specialists who are working on that for years, but we have also not many ideas when we ask.
Okay, Sarah, you wanted to come in there, did you?
It was just to say that, so in terms of energy costs, that the operator clients that we work for, sort of on average, are saying 350 to 450% increase in energy costs, and an average, that's sort of, let's say, a group of 10 to 12 plus 10 to 12 settings, plus having to raise their weekly fees by 10 to 15% just to cover that. And obviously, the recent bill will help there, but that is a big hit.
Okay. So it seems that we're coming to the end now. So from what it sounds like, it's still long-term positive for European healthcare real estate across all of the geographies and the sectors. There's pressure, short-term pressure on margins. We've got to build back better with ESG and investment in technology to improve costs, because it's going to be difficult to pass on all of these costs onto the end patient and resident. But otherwise, everything seems in the long term still well underpinned. Would that be correct?
Yeah, I'd concur with that.
Thanks, Julian. I get the nod from Julian. That's great. Okay, well, I think we'll end it there. So thank you very much for joining me on the panel today, Julian, Sarah, Frederick, and Charles-Antoine. And thank you, everyone, for joining us to listen to this discussion. Just a reminder that an on-demand recording will be sent to all registrations later this afternoon. But for now, enjoy the rest of your day. Thank you very much for joining.
Thank you.
Thank you, Nick. Thank you, everybody. Bye-bye.